When the market is soaring, it feels like the party will never end. Your portfolio is green, everyone you know is making money, and you feel richer every single day. This feeling is powerful, creating an illusion of unstoppable wealth. It changes how we act. We spend more freely, borrow more easily, and our appetite for risk explodes. The fear of missing out, or FOMO, completely takes over, pushing aside caution and discipline. Anyone who dares to suggest that things are getting a bit too heated is labeled a pessimist, someone who just doesn't get the new paradigm. We tell ourselves that old rules don't apply anymore, that this time is different. But history has a funny way of reminding us that it rarely is. The shift from a bull to a bear market doesn't usually happen with a sudden, dramatic crash. It's much more subtle, almost sneaky. The major indexes might still be hitting new highs, but if you look under the hood, something is off. Fewer and fewer stocks are actually participating in the rally. This is called narrowing market breadth. The gains become concentrated in just a handful of big, popular companies, the ones everyone knows. While these giants carry the market upward, many other stocks have already quietly started to decline. Other warning signs appear to margin debt, which is money borrowed to invest, often hits its peak. Corporate insiders start selling off more of their own company's stock. Volatility gets weird, with strange spikes and dips that don't make sense. In trading volume, the number of shares being bought and sold starts to dry up. Despite all these red flags, the headlines still look great. The S&P 500 or the Dow Jones are hitting record highs, so the average person assumes everything is fine. The financial news channels are full of optimism because good news gets more viewers than cautious warnings. It creates a feedback loop of positive sentiment. But while the public is still celebrating, many professional investors are quietly preparing for a change. They see the underlying weakness. Hedge funds start buying protection, like put options, to guard against a downturn. Large institutions begin to rebalance their portfolios, slowly selling off riskier assets without making any big announcements. It's not one single decision. It's thousands of small, gradual moves to reduce exposure. Remember, there's no bell that rings at the top of the market. While the pros are de-risking, many retail investors are still buying, lured in by rising prices. For many, the price itself is the only signal that matters. If it's going up, it must be a good investment, right? This goes on until, eventually, the last buyer has bought, the upward momentum stalls. At that point, all it takes is a single spark to light the fuse. The trigger itself is almost always unpredictable. It could be an unexpected interest rate hike, a major company reporting disappointing earnings, or some unforeseen geopolitical event. But here's the crucial part. The trigger doesn't cause the collapse. It simply reveals the fragility that was already there, hidden just beneath the surface of those record-high headlines. The foundation was already cracked. The trigger is just the thing that finally makes the whole structure give way. Understanding these dynamics doesn't mean you can perfectly time the market. Nobody can. But it does mean you can be more aware of the risks and make more informed decisions, instead of getting swept away by the illusion of a never-ending bull run. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more insights. What happens when the buying stops? When everyone who is going to buy has already bought, and the only thing left is the weight of debt. That's when leverage takes over. You see, when prices start to fall, margin calls kick in. And a margin call doesn't care about your long-term vision or your belief in the company's story. It only understands one thing: math. You either add more cash to your account, or you're forced to sell. This forced selling is the first domino. It pushes prices down even further, which triggers more margin calls for other investors. This creates a vicious self-reinforcing cycle. Think of it like a stampede. One person starts running, and suddenly, everyone is running, even if they don't know why. In markets where everyone is crowded into the same handful of popular stocks, this process gets supercharged. When the rush for the exit begins, everyone tries to get out at once. But there's a problem. There are no buyers left. Liquidity, the ability to sell easily without tanking the price, completely vanishes. All those buy orders, those bids, they just disappear. Your stop-loss orders, they become a trap, often guaranteeing you sell at a much lower price than you ever intended. This is when a 10% drop quickly becomes 20, and then 30%. Panic spreads like wildfire, far faster than any rational thought. At this point, confidence completely shatters. The old mantras, like buy the dip, stop working. The belief that central banks will always step in to save the day starts to fade. Fear takes the driver's seat, and fear moves markets with incredible speed and brutality. Now, a market crash isn't usually a single, dramatic plunge. It's more like a series of waves. You get an initial big sell-off, but then, you'll often see a rebound. This is the classic dead cat bounce. It's a cruel trick that fools many into thinking the worst is over, that it's safe to get back in the water. But each bounce is weaker than the last, and each new wave of selling drives prices to even lower lows. Historically, this entire cycle, from the absolute peak of the market to the final bottom, tends to last around 12 to 18 months, and the total damage, we're often talking about losses of 50 to 70%. This isn't just speculation. It's a pattern we've seen time and time again. Look at the Great Depression in the 1920s, the dot-com bust of 2000, or the financial crisis in 2008. They all followed the same four-stage playbook. First, there's euphoria, where it feels like prices can only go up. Then, the warning signs start to appear, but most people ignore them. After that comes a triggersome specific event that finally pops the bubble. And finally, the collapse. The specific triggers change, but the underlying structure is always the same. Why? Because markets aren't just driven by earnings reports and economic data. They are driven by human psychology, by greed, fear, and crowd behavior. And while technology and the world around us may change, basic human nature doesn't. Understanding this is key to navigating the turbulent waters of the financial world. Thanks for watching. If you found this breakdown helpful, consider liking the video and subscribing for more insights into how markets really work. See you next time. Have you ever looked at the stock market and felt a sense of déjà vu? A feeling that you've seen this movie before and you know how it ends? That's what a lot of seasoned investors are feeling right now. Today, we're going to dive deep into the unsettling parallels between the current market and the periods just before major historical crashes. This isn't about fearmongering, it's about being prepared. Let's start with what we've all been experiencing. The euphoria. For the past couple of years, it felt like the market could do no wrong. This party was fueled by an unprecedented concentration in just a handful of mega-cap tech stocks. You know the names. Their gravity-defying performance has pulled the entire market up, creating this illusion of broad, unstoppable strength. It's been an incredible ride, and it has drawn everyone in. We've seen retail participation hit levels we've never seen before. When everyone believes they can't lose, that's often the moment of greatest risk. But we've heard that one before, haven't we? The most critical one is the deterioration in market breadth. It's like watching a general leading a charge, but when you look behind him, you realize most of his army has already fallen back. These smaller companies are often seen as the canary in the coal mine for the broader economy. Now, let's talk about the triggers. It's rarely one single thing that causes a market to roll over. First, there's the excessive leverage we already talked about. All that margin debt makes the system incredibly fragile. When prices start to fall, those margin calls force people to sell, which pushes prices down further, creating a vicious cycle. Companies are facing higher costs and a more uncertain economic outlook. Now, higher rates make borrowing more expensive for companies and consumers, and they make safer investments like bonds more attractive relative to risky stocks. We also can't ignore the strain on the average consumer. Finally, we have a backdrop of rising geopolitical instability. Trillions of dollars are now in index funds and ETFs that automatically buy or sell stocks based on their inclusion in an index. In a downturn, as stocks fall, these funds are forced to sell indiscriminately, adding immense downward pressure. There's no human fund manager deciding if a stock is a good value. It's all automated. Then you have algorithmic trading. High-frequency trading firms use complex algorithms that can execute millions of trades in milliseconds. We saw a glimpse of this during the flash crash of 2010. And of course, there's the instant retail participation. Robinhood and other apps have made it frictionless for millions of people to trade. While this has democratized finance, it also means that panic can spread instantly. A wave of retail selling, amplified by social media, could add fuel to the fire. It's a simple truth. Higher starting valuations imply deeper potential losses. If you buy a stock at 100 times earnings, it has a lot further to fall than a stock bought at 15 times earnings. Yes, central banks and governments will likely step in to try and soften the blow. A common belief is that modern technology will prevent a crash, but history shows the opposite is true. Technology doesn't prevent crashes, it accelerates them. And more interconnected, which means it speeds up both the greed on the way up and the fear on the way down. A 50% drawdown in your portfolio could completely derail your plans and force you to work for many more years. Buy and hold offers very little protection to those who are nearing major financial milestones. Timing the market perfectly is impossible, but ignoring where we are in the cycle is irresponsible. This brings us to the most important point. What can you do about it? Preparation is not pessimism. It's about being rational and prudent. When the warning signs are this clear, it's wise to take some chips off the table. This could mean reducing your overall exposure to stocks, especially the high-flying momentum names that have led the market. Instead, you might prioritize companies with strong balance sheets, consistent cash flow, and durable business models, companies that can weather an economic storm. And let's talk about cash. In a bull market, holding cash feels like a mistake. A market crash, as painful as it is also a massive sale. The best buying opportunities in a generation are created during times of maximum pessimism. Having cash on hand allows you to become a buyer when everyone else is a forced seller. Market cycles repeat because human behavior repeats. The names of the stocks change, the technologies evolve, but the pattern of euphoria, complacency, anxiety, and finally, panic, is timeless. Understanding this pattern doesn't mean you can predict the exact day or week the market will turn. Nobody can, but it does mean you can recognize the environment we're in. And right now, we are in a late cycle environment characterized by extreme valuations, narrow leadership, and widespread complacency. The prudent course of action is to position your portfolio accordingly. Don't be the one caught by surprise when the music stops. Thanks for watching. If you found this analysis helpful, please give this video a like and subscribe to the channel for more insights on how to navigate these challenging markets. Stay safe out there.